All right, so let's begin. On the Money Show, we make sure that we just don't talk about investing in mutual fund, but also help you meet the brains behind the funds. And today we are going to talk about NPS. In the week's PTO Fund Manager, we have on board Sriram Iyer, CEO, HDFC Pension Management Company, to discuss about how can you start investing early in NPS to achieve your retirement goals. Sriram, good evening and welcome to the show. A very well-known retirement product investment instrument, NPS, and I can say, looking at the amount of questions that we get from our viewers, it's equally confusing for them in terms of product features. So let's break this down for our viewers, Sriram, and let's begin with how efficient it is, or NPS is, as a retirement investment product.
Good evening, Kavita. I think you hit the nail on the head. I think it's a product which is very poorly understood, in my opinion, and I'd like to start by pointing out four key benefits, and there are of course a number of other benefits, but I'm going to talk about the top four benefits that this product offers. As you would all know, as you would know, and your viewers would know, this is a product that was started by the Government of India for government employees in the year 2004. Eventually got opened out for private citizens the year 2008, 2009. And ever since, this business has grown from strength to strength, though the awareness levels continue to be fairly low. There are four key benefits, as I was saying. The biggest benefit that I see in this is obviously the fact that there is a very strong tax advantage or tax incentive that the government offers for investing in NPS, because India is a country where the social security system doesn't exist, and therefore helping citizens create a reasonable investment corpus or a retirement corpus is the key focus that the government has, and therefore there are some very attractive tax advantages that are available for investing in NPS. The most common one that's understood by most investors is the 50,000 rupee benefit over and above the ATC 1.5 lakh benefit. Incidentally, you can actually use the 1.5 lakh ATC benefit also to invest in NPS. So therefore, for a retail investor, up to 2 lakh rupees of tax benefit or tax deduction can be claimed if you invested in NPS. So that's point number one. For a corporate employee, however, for a salaried employee, actually up to 10% of the basic of the individual can be contributed towards NPS, which is a very, very powerful feature. So that's in fact, I would say a very, very powerful, feature that this product offers, and it is unparalleled truly. Second is it is an extremely low cost, actively managed fund. In fact, I would argue that this is possibly the lowest cost actively managed fund, lower than actually index funds as well in terms of cost. The fully loaded cost, and this was a study that the regulator had instituted, last year, and the conclusion that was drawn was that of course the fund management fees, as you would know, is between 3 paise or 3 bips and 9 bips, depending upon the size of the fund that the pension fund manager manages. But the fully loaded cost, as far as the subscriber is concerned, including other costs as well, is less than 10 bips per annum. What does it mean? It essentially means that for every 100 rupees that is getting invested, effectively 99.9 rupees is getting invested in the underlying. Contrasted with, let's say, other actively managed funds. And I'm not for a moment suggesting that those actively managed funds should not find a part in your portfolio. It should, but I'm just trying to draw a comparison in terms of cost. So other actively managed funds typically charge between 1% and 2%. So therefore, for every 100 rupees that gets invested, only 99 or 98 rupees eventually gets invested in the underlying, and that in turn gets compounded over long periods of time. And therefore, the impact in terms of the final corpus, purely on account of the fact that this is a low-cost product, can be as high as 25-30%. Of course, it's a function of what is the rate at which the fund is growing and so on and so forth. But, there are, some basic examples that will suggest that the difference in corpus on account of lower cost is as high as 20 to 30%. Thirdly, it's an extremely flexible product. There are, of course, we will talk about the fund choices available slightly later, but not just does it offer you flexibility in terms of fund choices, but it also allows you to invest in whatever quantum you want at whatever frequency you want. And as I said, at whatever frequency or whenever you want to invest, right? Finally, and this is again a very important, benefit about this product, is that this is a market-linked product, which means that whatever you're investing in this product is visible to you day in and day out in the form of an NAV that gets published. In fact, all the pension fund managers are also expected to publish the holding of their respective pension funds right in the last rupee. So you will see the disclosure available on the pension fund manager websites. So these are some of the key advantages that the product offers. Finally, and this is one thing that is not talked about enough, which is that this product actually forces you to stay invested for long periods of time, right? So this whole issue of investor return versus investment return being different in most other products which have a entry exit, and because of noise in the market, people tend to get out and get in. In this product, you are forced to stay invested because you cannot take out the money. Of course, you can take out some parts of the in your invested corpus at different points of time for specific reasons, but a large portion of the corpus has to remain invested till you superannuate, which is till the age of 60, or you could hold on till the age of 75 as well as per the latest guidelines. And that in itself will make sure that the corpus that you have created or the amount that you've invested builds up to a fairly meaningfully large corpus. So it's a very efficient product, actively managed, market linked, with tremendous flexibility and of course low cost that I spoke to you about. So those are the 4 or 5 key benefits that I wanted to shine the light on before we move to the next question, Kavita.
Although there is a lock-in in this product, I think till the age of 60, there are premature withdrawals or partial withdrawals which are allowed based on certain conditions. So what are those conditions, Sriram, if you could just highlight on that?
Minimum that you need to hold this product for, or rather you need to hold the investment for, is 5 years. Beyond the period of 5 years, you can do a full withdrawal. That full withdrawal will require you to annuitize. 20% of the corpus that gets accumulated is available to you tax-free. The remaining 80% needs to be annuitized, by which I mean you need to buy an annuity pension product with the 80% of the corpus that has got accumulated. Contrast to this, if you continue to hold on to this till the age of 60, then 60% of the corpus that gets accumulated is available to you tax-free. The remaining 40% has to be used for purchase of an annuity product. So that's the difference. And of course, through the life of the product, thrice you can withdraw up to 25% of your own contribution into the product, right? So those are the exit options that are available to you. However, given the fact that this is a product that is meant to help you create a meaningful retirement corpus, our advice to subscribers is to keep this invested and use your other liquid options available to you in other funds, in other vehicles that are there, so that you don't break this journey of the power of compounding that you're otherwise going to get in this product, and the low cost, of course, that this product offers you.
So let's, Sriram, also talk about the cost structure. You've mentioned this twice, that it's a low-cost product. In what way is it low cost? And from an investor's point of view, how is the costing structure as compared to the other investment instruments?
So the biggest element of cost in this is what is referred to as the fund management cost, or in any actively managed fund management charges are the highest, form the largest portion. In the case of NPS, the fund management charges are a function of the size of the fund. So I'll give you so it's a sliding scale. So up to 10,000 crores of assets under management held by a pension fund management company, the pension fund manager is allowed to charge up to 9 bips, 0.09%. From 10,000 to 50,000, you're allowed to charge 0.06%, and from 50,000 till 1,50,000 crores, you're allowed to charge 0.05%, and greater than 1,50,000 crores of assets under management at a pension fund manager level, you can only charge 3 basis points. So this is the fund management charges. Other than this, at the time of opening the account, there are some very, very moderate charges that are levied. So for instance, at the time of opening the account, you pay a 400 rupee account opening fee, and then there are some charges that you pay at the time of contribution. But as I was telling you, if you take all of these costs into account, if you look at the weighted average cost of managing money under NPS, it is less than 10 basis points, contrasted with, let's say, 1% to 100 to 200 basis points. So that's a contrast. So it's almost 1/10 to 1/20th of the cost of managing money in other actively managed products. So that's the comparison between the two. Kavita.
Sriram, let's also talk about the schemes, which investors can invest in. And before that, I think active choice and passive, active and auto choice, which you might want to highlight on. And then in a year's time, how many times can you change the schemes or, have a different kind of a strategy for yourself?
So I want to first start by explaining quickly what is an active choice fund and an auto choice fund. Under the active choice option, as the name suggests, the investor has the option to actively manage their asset allocation across the three asset classes that are available under this scheme, which is equity, which is signified as E, corporate bonds, which is signified by C, and government securities, which is referred to as G. So under E, C, and G, as an active choice investor, you can have whatever combination that you choose, irrespective of the age at which you are. The only condition that this active choice option requires you to do is that you cannot have an exposure of more than 75% to equities. So there is a mandatory 25% that you need to have between C and G, which is corporate bond and government securities, which means that an investor who starts early, let's say an investor starts contributing through his, let's say, corporate NPS, as I was referring to earlier, starts contributing towards 10% of his or her basic into NPS, you can actually choose to have 75% exposure to equity right through your lifetime employment lifetime, but actually beyond that as well. So that's the active choice option. Of course, you have the choice of calibrating it to less than 75 as well. You could have a 50% exposure. So active choice essentially is the investor is given the choice of deciding what the combination of asset classes can be. That's the active choice option. The auto choice option, which I like to refer to as the fill it, shut it, forget it option, is actually ideally suited for a large number of investors in India who do not want to get involved in the asset allocation decision, right? So what this does is that it's a beautifully structured, option where up to the age of 35, you could have allocation in equity. So there are three types of auto choice options. There is the moderate, conservative, where 25% equity allocation happens to equity and 75% to corporate bonds and government securities. Moderate, where 50% gets allocated to equity and 50% to corporate bonds and government securities. And aggressive, where 75% gets allocated to equities and the remaining 25% gets allocated to corporate bonds and government securities. Now, the beauty is that this is the allocation at the time of getting in. From the age of 35 till the age of 55, which means for those 20-year period, what this product does for you, what the auto choice option does for you. Let's take the example of aggressive auto choice option, where the 75% allocation is to equity. So from your birth date, every birth date after 35 years, the allocation to equity will get pared down. So it is a reducing allocation to equity as you progress from the age of 35 to 55, which means that the risk of the investor is being automatically managed by the product without any intervention from the investor, which means that it automatically rebalances your portfolio in such a manner that at the age of 55, under the aggressive option, 15% allocation is what is left in equity at the age of 50, which means that as you get closer to your retirement age, your allocation to a riskier product, which is in this case equity, is pared down significantly. And therefore, in the initial stages of your investing life cycle, you have maximized the opportunity to make returns out of equity. And as you get closer to superannuation, the quantum of allocation to equity reduces. So that is how this product of the auto choice option allows an investor to actually bring down a risk with increasing age, and as one gets closer to retirement, your corpus is less volatile than what it would be at the age of 35. So that's the difference between the active choice and the auto choice option. Kavita.
Sriram, if I have to focus slightly on the annuity part, 60% is EEE, and out of the 40% of total corpus, you need to buy an annuity. What are the features of this annuity in terms of how do you get it? You get it monthly, you get it quarterly. Also, will that annuity be taxed, because that's the ultimate amount that's coming in your hand, in terms of pension. So what are the rules over there?
I want to first, clarify one thing. This is an EEE product, which is exempt product at every stage, which means that the final corpus that one is getting is also the corpus is fully exempt from tax. 40% out of that corpus is to be invested in annuity as a product, right? Which is a pension product, as it is, colloquially referred to. Annuity as a product, which means that you start getting pension out of the 40% that you invest in that. So that 40%
entire 100%, right?
Yeah,
But
so the
Sriram,
entire 100%.
I cannot withdraw the entire 100%. It is a mandatory
Cannot.
40% annuity that we have to buy. Even if we don't want to. What if someone doesn't want to? I mean, there is no option in NPS. I mean, you have to put in that money in your annuity. Just 60% is something that you get in your hand eventually.
Sure.
Yeah.
The reason why, and Kavita, I want to sort of spend a minute on this debate, that this is a debate that keeps happening as to you don't allow me to take the entire 100%. You force me to buy an annuity for 40%. The reality is that a very large number of investors do not really very well understand how to manage, let's say, something like an interest rate risk over the rest of their lifetime, right? So let's say you superannuate at the age of, or retire at the age of 60, and you, let's say, take the money out at the age of 60. The product forces you to lock in a certain amount of money at a fixed rate of return for the rest of your lifetime. That's what an annuity does, right? So what is an annuity? Annuity is possibly the only product which guarantees a fixed rate of return. And optically, the rate of return may potentially, you may say, what is so great about 6.5%? But the reality is that the 6.5% or 7% or whatever is the rate on and there are different options under annuity, with return of purchase price, without return of purchase price. I don't want to get into the complications around the annuity product. But if you look at the fact is that 10 years from now, the interest rate scenario may be very different, by which I mean it could be significantly lower than what it is. At that point of time as well, you will continue to earn the rate at which you've locked into the product at this point of time. So the annuity option actually helps you obviate or overcome the reinvestment risk that typically runs with respect to any fixed income option, right? Any fixed income option over a period of time, you do get into an issue of reinvestment risk, because when the product matures, then whatever product you invested in, let's say 5 years, 10 years from now when it matures, the interest rate scenario at that point of time could be very, very different from what it is at this point of time. And therefore, this in some sense helps you manage the reinvestment risk for a portion of your corpus. So that's what this annuity option does for you, Kavita.
Right. I think that will be all for today, Sriram. Thank you so much for being on the show and covering the most crucial aspect of NPS. Thank you so much.
Entirely my pleasure. Thank you so much. Thank you for having me.
All right, time for a quick break, but then post that, let's talk about reviewing the performance of your mutual fund and how should you go about it in case of a regular or a direct plan after this break.